Okay, it gives a single figure. The NPV which can be used to assess the value of the investment project. The NPV of a project is the amount by which the project should add to the value of the company in terms of today's value. NPV of a project is the amount by which the project should add to the value of the company. Are we there? The NPV method provides a decision rule which is consistent with objective of maximization of shareholders' wealth. And then the disadvantages. The time value of money and present value are concepts that are not easily understood. Very difficult. There might be some uncertainty about what the appropriate cost of capital or discount rate should be for applying to any project. Cost of capital is considered in more detail somewhere else. Okay. So that is that on NPV. Let's look at IRR. The IRR is another method of investment appraisal using DCF. Okay. The internal rate of return of a project is the discounted rate of return on the investment. The internal rate of return, of a project, is the discounted rate of return on the investment. Okay. All right. The internal rate of return of a project is discounted rate of return on the investment. It is the average annual investment return from the project. All right. Discounted at the IRR, the NPV of the project cash flow must come to zero. The internal rate of return is therefore the discount rate. Another one, IRR is the discount rate, okay, that will give a net present value of zero. A net present value of zero. Okay, zero is equals to 0 naira. Or it's equals to 0 naira. Okay, so how do we decision rule under IRR? A company might establish the minimum rate of return that it wants to earn on an investment if other factors such as non-financial consideration and risk and uncertainty are ignored. If a project IRR is equal to or higher than the minimum acceptable rate of return, it should be undertaken. And if the IRR is lower than the minimum rate of return, it should be rejected. Okay, should be rejected. So formula for IRR is equals to IRR is equals to A percentage plus P, that is plus all right, so plus P all over P plus N times B minus A percentage. Very clumsy formula, isn't it? Let me explain it a little bit. A here, A percentage, stands for the lower percentage. Lower percentage. You see, the point about IRR is that you will have computed an NPV. If the NPV gives you a negative NPV, you will have to compute, you assume another rate, okay, cost of capital, to compute another NPV that must give you a higher rate. If that was giving you negative, this should give you positive. Are you following it? So now, for example, if you had used 12% and it gave you an NPV of, say, NPV of 100 negative, you should look for the rates with percentage that will give you an NPV positive. Possibly you move it up higher. Once it gives you negative, the other side should be higher. Okay? Then, if that is the case, you now, you drop it down. If it was 12% and it gave you a negative, you should be able to go down to say maybe 10%. Okay? Or 10%, yeah. So at the end of the day, you are going to have two rates, lower rates and higher rates, 12% and 10%, for example, here now. You agree with me that 12 is higher, 10 is lower. Then the NPV you got when you did 12% is represented by P here, P, the P you are seeing here, the first NPV. Then the second NPV you got, the positive NPV, is represented by N here. So if you look at this formula, there's P up there, that is NPV1. Some formula will call it NPV1, all over NPV1 plus NPV2. Maybe that will have even been, let me translate, let me put this formula in another way that you can understand. Maybe that makes it better. So let's say is equals to, okay, lower rates plus, open this bracket, NPV1 all over NPV1 plus NPV2, which was how I was taught, times, okay, higher rates minus lower rates percent. This makes it a bit better. At least you can see NPV1 and NPV2. Then that means you must get two NPVs. One will be higher, one will be lower, one will be negative. So one will be negative, one will be positive. So if you have this, you can take any question on IRR. Let's look at advantages. Advantages of IRR. As a DCF appraisal method, it is based on cash flow, not accounting profit. Like the NPV method, it recognizes the time value of money. It is easier to understand an investment return as a percentage return on investment than as a money value. For accept or reject decision on individual project, the IRM method will reach the same decision as NPV method. Disadvantages. The disadvantages of IRR method are: 1. It is a relative measure, not absolute measure. That is, talking about percentage on investment, not absolute measure in Naira. Okay. 2. if the investments are mutually exclusive and only one of them can be undertaken, the correct answer is that it depends on the size of each of the investments. Okay, this means that IRR method of appraisal can give an incorrect decision if it is used to make a choice between mutually exclusive projects. 3. Unlike the MPV method, the IRR method does not indicate how much an investment project should add to the value of the company. Okay, so that's that. Let's see what else. Now we go to the review question. These are the review questions. 1. Which of these is not an example of financial objective that a company might choose to pursue? Financial objectives of a company. 1. Provision of good wages. Is that restricting the level of gearing to below a specified target level? Dealing honestly and fairly with customer on all occasions? Producing environmental friendly products. Financial objective. The key word here should be financial. It must have a financial implication. Let's take A, provision of good wages. Yes, that's finance. Money goes out. Some persons are paid. It will involve money going out. Next, restricting the level of gearing to below a specified target level. That is also, you know what gearing is. Gearing of a company, that shows the capital structure. How much of the company's capital structure is made up of debt. It also has to do with money. Dealing honestly and fairly with customer on all occasions. Producing is, my take is between these two. It's not an example that a company might choose to pursue. Not an example that a company might choose to pursue. I will want to be comfortable with D, producing environmental friendly products. They wouldn't want to take that. Whether it's friendly or not, the product is, as long as it is bringing in returns and the financial objective is achieved. The long run objective of financial management is to maximize the value of the firm's common stock. Okay, long run. Maximize market share, maximize return on investment, maximize earning per share. Long run objective of financial management. The long run is to maximize the value of the firm's stock. Okay, here. For a certain project, the MPV at a discount rate of 15% is 3,607, and the rate of 15, the net PV negative. What is the DCF, rate of return of the project? This is IRR being tested here now. Okay, this is IRR being tested. Good, this is a good one. So let's use this to work IRR. IRR is equals to, okay, lower rate, okay, plus this MPV1 all over MPV1 plus MPV2, right, times higher rate minus lower rate. So this is it. So let's put in the numbers. It's equals to, they are now asking for this IRR. It's equals to lower rate. You agree with me? Lower rate is 15%, because we have 15 and 18 there, plus MPV1. The first MPV negative. Usually the first one will be negative. That is 1390. In this place now, you use absolute figure all over MPV1 again, 1390 plus MPV2, which is 3,670. Okay, all of this times 18% minus 15%. Okay, so your calculator, 18 minus 15 gives me 3%. Let's work this out. I want to work this out first. That is 1390 plus 3670 give me 506. So 1390 divided by 5060, that gives me 0.274. So all this is 0.274. 0.274. So that is starting point 0.274. Okay, now multiply that by 3%. That is, this is giving me 3%. 0.274 multiplied by 3%, that gives me 0.822 plus 15%. 15% plus this, that gives me plus 15%, that gives me 15.82. 15.82%. That is how you get your IRR. Here, what is it? 15.82. There's nothing nearer to that. What I have is 15.7. Okay, 3670, 15, 18, yes, 3. 1390 all over 1390 plus 3670. That gives me how much? Let me do that again. 1390 plus 3670. 5060. Did I get that? 5060. Okay. 5060. 1390 divided by 5060. That gives me 0.74. 0.747 or 75, okay, times 3, that gives me 0.824, okay, plus 15, that should give me 15.82. So I wouldn't know, but this should be the nearest to the answer there. But this is the formula, how I've applied it, the IRR rule that looks very complex. So if once you have all this information, you should be able to do it. Okay, let's see now. Number 4, a merchant pay 100,000 for a loan of, and it is certain that it can be resold at the end of year 1 for 132. If the rate of interest is 10%, what is the present value of the investment? Present value of the investment. So, present value. What's the formula for present value? We'll go and get that. Of course, the present value for this will be the difference between, because difference between 132, difference between this and 100, which is this B. Which of this is not an advantage of payback period? Payback period. It is simple to calculate and understand. Yes, it is. It uses readily available accounting data. No, payback does not use accounting data, so this should be the answer. It serves as a first screening process. Yes. Of all the appraisal technique, it is least affected by uncertainty. Okay. Yes. In most capital budgeting decisions, the emphasis is on the emphasis is on A, reported income. No. B, cash flows. C, short-term profit. G, maximization of shareholders' wealth. I think I want to look at here this and this, but I'm more with D than with B, because capital budget always involves cash flow, but the emphasis is on maximization of wealth. Remember your MPV, that your MPV, if your MPV is positive, it means that is the amount that the shareholders' wealth will be increased with the growth. That shows how much. The NPV shows how much of the shareholders' wealth that we grow. How much will be added to the shareholders' wealth. How much will be added to the shareholders' wealth. Okay? Which of the following is correct about internal rate of return method? Each project has a unique internal rate of return. As long as you are not dealing with mutually exclusive project, capital rationing or unusual project having multiple sign changes in cash flow, the internal method can be used with confidence. Internal rate of return does not consider time value of money. This is wrong. Internal rate of return does not consider time value of money. It considers NPV. It takes care of NPV. Okay, and the answer, which of the following is correct? Correct. Okay, it's like every other one is not correct, except the internal rate of return is here rarely used by firm today because of the ease at which NPV is calculated. Yes, I think I'm okay with this. It is used with ease. This is okay for that. Okay, so that is the end of this.